Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at some financial results of two Canadian-owned banking giants listed on the Trinidad and Tobago Stock Exchange. We're speaking, of course, about CIBC Caribbean as well as Scotiabank Trinidad and Tobago Limited. Now, both groups would have reported some fairly challenging results in terms of their earnings per share, and who knows, we may not be able to say that those groups are, or at least one of those groups are going to be Canadian-owned in the foreseeable future. Let's take a look at what investors might expect in the coming months ahead. Turning firstly to CIBC and for their fiscal half year ended April 2026, well, the group would have reported an earnings per share figure of 44 cents per share TT dollar equivalent, which is a 7.1% decline from the 47 cents TT equivalent reported in the prior comparable period of fiscal 2025. Now, impressively, revenues were up just about 5.2% from 2.47 to 2.6 billion TT dollar equivalent. Operating expenses, however, increased 7.2% from 1.5 to 1.6 odd billion dollars, with credit loss expenses swinging from a release in the from a higher level of 92.5 million in that fiscal period of 2025, down 71% to 65.8 million in the most recently concluded period. Net income attributable to equity holders ultimately declining 9.3% from 757 odd million to just about 687 odd million TT dollar equivalent. When we take a look at the revenue story for CIBC, we can see that, again, that fairly impressive 5.2% growth, however, overshadowed by increasing operating expenses. But from a revenue perspective, net interest income up just about 2%, or from 1.78 billion to just about 1.82 billion TT equivalent. Other operating income improving roughly 13.6% from 688 million TT equivalent to just about 782 million TT dollar equivalent. From a profit before tax by segment perspective, we can see some notable changes. Corporate and investment banking would have increased in terms of its PBT just by about 1.6% from 639 to 649 TT dollars, or million TT dollars rather. Personal and business banking, that orange segment, declining from 253 to 196 million, a roughly 22% decline, and with the wealth management segment actually swinging from a prior loss of 48 million TT dollar equivalent to just about 15 million TT dollar equivalent in that most recently concluded period of the half year of 2026. Now, from a price earnings ratio perspective and looking at the entire banking sector, CIBC is trading on the higher end of the banking sector price earnings, or PE multiples, at 12.6 times compared to that banking sector average of 10.2 times. For comparative purposes, for example, Republic Financial Holdings is trading at a lower multiple of about 7.8 times at this particular point in time. Now, again, at that price of $7.74, CIBC is trading at that price earnings ratio of 12.6 times and offers investors a dividend yield of 4.4%, which is below the sector average of 5.3%. Of course, keep in mind that CIBC does offer its dividend payments in US dollars. Now, of course, one of the major notable changes in recent times for CIBC or related to CIBC is the pending change of ownership, whereby Bank of Butterfield is or has made an offer to the parent company of CIBC Caribbean for its full stake, or roughly 92% holdings in CIBC Caribbean. And that change is expected, pending regulatory approvals, of course, to take place sometime in the first half of 2027. Investors will be receiving, once approved, of course, a package comprising roughly 70% cash, as well as the balance in, or roughly 60% cash rather, as well as the balance in NTB or Butterfield shares. And that, again, as mentioned, is expected to take place sometime in the first half of fiscal 2027. So for the time being, and based on that moderate revenue growth, those high operating expenses, that pending change of ownership, as well as those US dividend payments, Bourse is going to maintain its market weight rating on CIBC for the time being with a watch outlook. Turning very quickly to Scotia for its fiscal half year, the group would have reported an earnings per share figure of $1.71, which was an 11.5% decrease from the $1.93 recorded in that prior comparable period of fiscal 2020, half fiscal of 2025. Net interest income increasing just about 2% from 754 million to 769 million. Overall revenues would have increased just about 1.2%, still above the $1 billion mark. However, profit attributable to equity holders would have declined 11.5% from 340 million to just about 301 odd million. Again, from a revenue trajectory, we can see that this has been the third consecutive period of growth in terms of revenue for Scotia, however, at a much lower rate of growth at that 1.2%, with that 2% net interest income growth offset by a roughly 1.6 to 2% decline in other income growth, falling from 256 to 253 million, however, relatively range bound within that 250 to 255 million dollar range over the past three comparable periods. When we take a look at Scotia's operating efficiency, this was really where the notable change would have taken place. In terms of overall profitability, with operating efficiency, that particular ratio increasing from 41.7% to just about 47.2%. Most of that attributable to the asset tax, which would have been implemented and ultimately impacted Scotia's non-interest operating expenses. From asset composition perspective, we can see some notable changes. Total loans in that purplish segment up around 2.8% from 21.1 billion to just about 21.7 billion. Investments in the greenish segment fell just about 24% from 7.5 billion to just about 5.7 billion in terms of holdings. Ultimately, just about a 4% decline in total assets for Scotia over the comparable periods, falling from 32.2 billion to just about $31 billion for the most recently concluded period. And again, like CIBC, trading at the higher end of the multiple spectrum for the banking sector at around 12.2 times. So at that price of $45.48, again, Scotia is trading at a price earnings ratio of that 12.2 times above the sector average of 10.2 times, and offers investors a fairly generous dividend yield of 6.6% above the sector average of 5.3%. Of course, with the impact of the asset tax, it remains to be seen what or if any changes would be made in terms of dividend announcements as subsequent periods come by. So with that, on the basis of modest revenue growth, those higher non-interest expenses, those ongoing market uncertainties at the macroeconomic level, and a fairly above average sector valuations, Bourse is maintaining its market weight rating on Scotia for the time being with a watch outlook. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773, email us at info@boursefinancial.com, and of course you can check out our website, bourseinvestment.com, where all of our research is absolutely free, and you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.